Hello, hello, hello. Welcome, guys, to this afternoon webinar. Hello, Janos. Hello, everyone. My name is Theo, and I will introduce you to your host for today, Jens. We are just waiting for Jens to join us. But just to make sure, guys, I shared with you the YouTube channel, the Instagram page and the Telegram page. So please make sure you follow us on this social media and you like the videos. I will just walk you through in a sec. Today we have the non-farm payroll just came out event a while ago. We see that the US dollar gaining some strength. I was watching closely the gold, to be honest with you, and I see that the gold is losing a lot of value. Guys, as you know, most of you, I assume that you know, we have our native mobile application, so you can download it from the App Store, from the Google Play. So please make sure, if you haven't downloaded yet, to install this mobile application to your device. And as for the social media, please allow me to walk you through. This is the Admiral's Telegram channel. I shared the link on the chat below. Please make sure you download the Telegram if you haven't it, and you follow us here, because there is a lot of valuable content and information. Also, when we go live, you can get all the notifications. Also, we have the Instagram channel here, Admirals Global. Again, a lot of context, reels, videos, trading ideas, everything happens here, so you can get informed easily. And the last one, and my favorite one, is the YouTube channel, because not only you can also go live from YouTube if you want, but also you can find all the recording webinars that Jens is hosting. So you can click at the trading spotlight and you can find all the valuable information from Jens and the other traders and educators. Okay, also, guys, I really encourage you to subscribe to the live trading I do on a daily basis, Monday to Friday, from 7:30 until 8 a.m. UK time. And without saying furthermore, allow me to introduce you to the one and only Mr. Jens. Hello, Jens.
Hello, Theo. Too nice.
How are you?
Well, let's see how things play out. So I was, let's say, kind of bullish coming into today's NFPs, and I just saw the release. And equities, as of now, at least, selling off, and a little different to what I expected, to be honest. So
yeah.
Could be ultra bearish, to be honest. But let's see. I mean, I prepared something. Yeah, let's probably. I share my screen. Let's jump here right into the action.
Okay, so. I leave you with the audience, right? I think you don't need me.
Well, you can stay if you want. Ask all your questions.
Okay.
Wait a second.
Thank you so much.
Hello Traders is here for the chat box. So this is where you can ask all your questions. Also YouTube.
Okay, certainly. Great. Yeah. Okay. I'll see you later.
Hopefully. Yeah.
Thank you.
Come on. So let's start. Let's trade the NFPs. Certainly we will have this webinar here for educational purposes only. First of all, so if we will see any trades being made from my end, please be aware that if you copy these, if you do them yourself, that you take full responsibility for the trades and take all the risk. The good thing about this is that you can also keep all the profits, which will potentially arise if they arise. Well, this is the big if here. As I already said at the beginning, my expectation was met in terms of the print itself, but the reaction in the market is different to what I saw. So why this is and so on and so forth, this will be part of today's webinar. Before we start, first of all, here the risk disclaimer. Please read it carefully. Again, purely educational content we provide here. If I do make any trades, then again, it's just to illustrate my thoughts. It's in a demo account, so no live trading taking place here. If you plan to take these trades, please be aware of all the risks involved when trading these products. So I don't think that I need to introduce admirals any further, because Theo did all the work here at this end. So probably let's just jump right into, first of all, the theoretical aspects around the non-farm payrolls, and why the employment situation in general is of interest, and then dig deeper into why this matters in the current environment, especially. So first of all, why are employment numbers of interest? So confidence in the economy, respectively, in the political situation is good, is positive. Well, what's happening naturally in a purely theoretical context is that orders in factories, or in general, the overall outlook for the economy, in this case, the US economy, brightens up. So you have an increase there, more optimism, which naturally results in more industrial production when it comes to especially the manufacturing sector. But also in the non-manufacturing sector, you will naturally see that companies will meet higher demand through more investments, so offer more products which will be which they deliver to the market, and they meet the rising demand and make more money in this context. Use the money to produce more. To produce more, you need more people, which you will pay well, so that they can spend more, which will naturally positively affect the overall economy, as you can see here in the next bullet points. So the result of meeting higher demand is you hire more workers. More workers mean you have more people earning a good living, especially if you pay them well, and if you have a rising gross margin, for example, in terms of your product, which means like you have average hourly earnings, which should also, and average hourly wages, which should go up. Higher income, increasing consumption, higher propensity here to consume. And the result, and this is what it's all about and why this number plays such an important role, is you have higher economic growth, you have rising inflation. Right now, as you can see, rising inflation is not due to rising economic output and more people consuming, but it's more due to supply chain issues, respectively a supply issue in general. And then what the central bank naturally does is it's motivated to raise interest rates to avoid an overheating of the economy, or inflation to rise too high too quickly. So right now you can see while the overall employment situation is let's say darkening, probably a good way to put it. There were several indications over the last days, in fact, which underlined that it's not ADP numbers or NFPs in this case, so non-farm payrolls we will look at today, but also ADP for the private sector from Wednesday, but I'm especially referring to the JOLTS, which were published on Tuesday, and which showed that job vacancies were really shredded from companies. I think 1.2 million jobs or job vacancies in this case were cut. So we are coming from a quite elevated level. We can probably, by the way, let me just probably head over here. So this is the non-farm payrolls from today. We'll dig deeper into these in a few seconds. But when talking about JOLTS, that's probably important, because now let's have a look at the United States. We look at the labor sector, and then we look at the, let me just see where we have it. Where do you have it? We have the job offers here. So this is the JOLTS, and you can see here the crush lower. As you can see, the number of job openings in the US dropped to 10.1 million in August, the lowest since June 2021, and downwardly revised 11.2 million in July and a record level of 11.9 million in March. Figures came in below market expectations, 10.775 million, but we're still above pre-pandemic levels, suggesting demand for workers remains strong. Well, this is a positive interpretation. Let's have a look here at the last, let's say 10 years. You can see it there. So still elevated, no question about that. But if you see such an acceleration here on the downside, that's usually a sign, especially in the current environment, that companies are not looking that strongly for working people anymore, and are planning to increase their production, let's put it simply, but are more skeptical about the overall economic outlook. You have probably also seen, let's have a look here, Facebook, Zuckerberg, probably that's already okay. Let's see, CNBC probably. What do we have here? Death spiral, no. Howard expert. Let me just see if the numbers, if this is topic here. Here, there we go. That's what I was looking for. There was a news which hit the wire on October 1st. That's around 1 week ago. Okay, yeah, well, I don't want to read it for free now. I don't want to here have a look. But as you can see, hopefully, let me just see, probably we do it that way. You can see it already here. So it's continuing. No, Metaverse will unfold here. Meta freezes all hiring, warns of possible slowing down of the overall economy. So just an indication, but something you can now read over all channels over and over and over again. And this is a sign that the overall economy is somehow, how can I say that, slowing down. Probably we're really headed towards a very harsh reality, facing a really harsh reality with an economic downturn / recession, especially in the US, but I mean overall, which is also underlined by a statement then from the UN from Monday. Let me just see here, UN Fed, that's probably here. That was a news which hit the wire. Look here. So that was the Wall Street Journal that day. So UN calls on Fed, other central banks to halt interest rate increases. A UN agency warns that further policy tightening risks a global economic downturn. So now things start to make sense already. Why the overall employment situation is a very important indication of how the overall US economy in our case today, with looking at the non-farm payrolls, plays such an enormous and important role. So if you have a cool down of the labor market, and then Fed, which is increasing not just tightening the monetary policy further, after already going beyond what is normal, let's say, from a historical perspective, with hiking rates by 75 basis points now, I think 2 times a row, 3 times, I'm not sure, June, July, I think September. Did they start in July? I'm not really sure. But however we put this, so we see that a cool down in the overall employment situation should usually mean that this affects the overall monetary policy stance from the Fed. So coming back to today's topic, to the presentation. So this is the theory behind this, why this matters. But what interests us is, like, how can we use this information now around the non-farm payrolls, first of all, to formulate a game plan, respectively, then to trade this news event, to make sense out of it, and then draw conclusions and probably explain what's happening in the chart right now, and then using this information to formulate trade hypothesis and then trade based on that. So what we have here is a so-called Fed Watch tool. You probably have seen that before. We had this Fed Watch tool around the Fed rate decision around 1 month ago. And what we have here is different columns which show a probability with which market participants at the CME, Chicago Mercantile Exchange, in the futures market, expect the Fed to have their rates at a certain point in time or in the future. So currently, the target rate is 300 to 325 basis points. And so now you can see here, so this is for December. It's not for November, but as you can see in December, at the end of this year, market participants at the Chicago Mercantile Exchange here via the Fed Watch tool. You can illustrate this, by the way. Let me just, oh, that's probably not a good idea. Let me just share the link, copy link, there we go, and then post it here. So I call this Fed Watch tool. So you can see it yourself. We will head over to the website ourselves in a few seconds. That was a screenshot I took yesterday. So this changed a little, as you will see in a few seconds. But all in all, it's no big deal, to be honest. So market participants expect the Fed to hike another 75 basis points right now in November. And they expect the Fed to hike another 50 basis points then at the December meeting, despite the warning from the United Nations, despite a very interesting development we saw on Tuesday with the Reserve Bank of Australia, who went for 25 basis point rate hike at her meeting. And was expected to hike rates by 50 basis points. So only 25 instead of the expectation of 50. That was probably one of the reasons why we saw this sharp drive higher in equities, especially. So probably you have wondered why we saw such a strong move on Monday and on Tuesday. And then with a consolidation here over the last 2 days. And the main reason seems that market participants are now start to expect the Fed to slow down in terms of rate hike expectations. And so that information being used now, let's just come to today's non-farm payrolls. Let's come back here to the tweet. So that was what I tweeted several minutes ago, shortly after the release was done. So for September, non-farm payrolls came in at 263,000 against an expectation of 255,000, so slightly above expectation. The interesting thing is that could have been expected. And why? Well, because ADP data, ADP is for the private sector, came in around the same amount already on Wednesday. Let's just head over here again to trading economics and look at countries and United States. And by the way, we will use this information now and see what happened on Wednesday. So that's probably a very, very interesting pattern we can then use to formulate a trade hypothesis. But first things first of all, let's have a look here at ADP data. So why is the ADP data set of interest? First of all, we already had this data set before the non-farm payroll, so we can use it to formulate an expectation for the non-farm payrolls today. Why can we do this? Well, because we know that if we compare for the last month's ADP with the NFPs, you will see, oh, by the way, I'm sorry, let's put it differently. Non-farm payrolls, there we have it. Unfortunately, due to this COVID volatility, you can't really see that. But if you zoom into the chart, which we can't really do right now because that's not something which is supported here from trading economics, but you can see there's a usually high positive correlation. So simply speaking, if you have an ADP print which comes in above expectation, you usually expect NFPs to come in above expectation too. As you can see here, we had an expectation of 200,000 ADP, and then we came in at 208, so slightly above expectation. It's not set in stone, so it's like something which varies sometimes, but it gives you already an idea of where things will go then with the print on Friday. If there's a big surprise, then usually you have higher volatility. But in this case, this print came in at 208, and as you can see here, slightly above expectations, similar to the ADP, something we've seen now for the non-farm payroll. So this positive correlation is still given, which underlines also an idea around what to expect in terms of markets to do now, especially equities. But again, several seconds, and then we will head over to the charts. probably the main reason why the market currently is reacting like it's reacting, so with equities being sold off, is because the unemployment rate came in below expectation. So expectation was 3.7, came in above last month, for example, now comes in at 3.5%. Not really sure if I should, if you should really pay that much attention on unemployment rate. But all in all, what we can say is it's a solid trend, but nothing outstandingly positive. That's probably a good way to put it. That being said, now leaves us with the question, leaves us with the question, why is this happening in terms of the DAX? Respectively, let's head over to the NASDAQ especially. Why is this happening? So this is now the NASDAQ on a 50-minute chart. And you can see here, that is the NFP candle, and we're selling off sharply. So why this reaction? To be honest, I have no idea, because it doesn't make sense. My hypothesis, as you can see here in my slides, what I usually do is I formulate scenarios. That was the scenario, the only scenario I prepared, in fact, because I had a very strong bias for today's NFPs. And as you can see here, I write neutral scenario. So it's kind of a non-event, in fact, what happened, because that was something which could have been expected after the IP data was released. You can see here, I write NFPs come in around expectation, and you can see I define what's around expectation, 250 to 280. Coming back here again to the tweet, it's 263. Okay, so that's where we come in. Unemployment rate, that's wrong here. It's greater 3.5%. Now it equals 3.5. But as you can see, I'm writing 3.5%. So I had this number already in mind, even though last month the numbers were 3.7%. And then I write likelihood 60%. Now, certainly there's also some opportunity that we probably come in below expectation, some above expectation. I would say expectations below were 30% in my case, 10% above means significantly above 300,000. But this is the scenario, as you can see here. And then what I do is I first of all ask myself, okay, which markets will be most likely be affected in which way, and how do I plan to trade it? And in this case, I'm not really looking at the NASDAQ, but here I'm looking at the S&P 500, and I'm saying it's bullish above 3,720. I, in fact, consider likelihood. In my mind, I'm playing a scenario where I say, well, I see the flush lower, but I'm not really seeing the market here breaking significantly below 3,720, but being bought back right from there. If flush is 2, but holds then above 3,720, I'm writing, then I'm long target 800 plus in the next days. The same is true here for gold. We will check the charts in a few seconds, but this is exactly what I'm doing in front of the event. So first of all, let's break this down first, and then head over to what to expect now and how to trade it from the Wall Street Open at in around 10 minutes from now. So first of all, I make sure that I understand why the data set matters, especially in the current environment. This is especially true for inflation data right now, but right below this, I can find employment situation to be of interest, because the employment situation is something the Fed will definitely look at when making decisions in terms of the next steps within her monetary policy path they are following. So I make sure I understand what's currently driving the market, in this case, the macro event, and why it matters. That's the first thing I need to make sure. Then I look at where do we stand? What do we expect? Not just in terms of the print itself, but if the data comes in at a certain range, how will it most likely affect the expectation among market participants? I make sure that I understand what's the current bias among market participants by watching at the Fed Watch tool. In this case, now I have also here the Fed dot plot. probably it's better now. We skipped this step. I included it here, but in fact, it's probably better to watch the video on the Fed rate decision around, I think 2 weeks ago. We did this, or 3 weeks ago, and check out what I said around the dot plot, what it is and why it mattered back then. Right now, it's a little too much, too difficult to pathologically. So I want to skip this step here. And then in the next step, I make sure that I understand which markets will most likely be affected by this news event. So why does it matter? Where do we stand? Where the data comes in? Where do we stand? And if the data comes in a certain range, which happens certainly between above or below expectations, and you have these numbers within the Forex calendar at admiralmarkets.com. And then what you do is you formulate scenarios. So which markets will most likely be affected and how will they be affected once the number comes in as I expected to come in. And then I formulate, okay, for the S&P 500 in this case, due to its reaction to the recent numbers, not just employment-wise, but also inflation and the Fed itself, how does it react? How did it react in the past? How will it most likely react here? I look at gold. It's a yield-sensitive asset. I look at dollar JPY. In fact, it's also very yield-sensitive. And then I take it from there. And now the dust has settled. We are several minutes away from the market opening, and now I have a look here. So what happened? What happened? First of all, I need to make sure. In this case, now we are looking at the S&P 500, and we look at the hourly chart. And as you can see, we had a very strong move into the start of the week, into the start of the quarter. In fact, historic-wise, that was really a historic move, because the last time we started that strongly with 5.7%, if I'm not mistaken, into a quarter. Last time this happened was in 1938. So that was in the second quarter, 1938. Back then, something like 8.5%, if I'm not mistaken. And over the last, or the next months, 8 months, 9 months, then the S&P gained in 1938 more than 40%. So long time ago, the last time we saw such a strong back-to-back rally on 2 consecutive trading days, that was in fact in April 2020. So have a look at how things played out back then. So, I mean, no big surprise. That was the start of this post-COVID rally, in fact. So all in all, we have a very strong tendency, or a very strong overall picture given this run here, and an overall switch toward a more bullish stance. And somehow market participants probably start to be really scared. Some market participants, especially probably the big guys, start to be scared that probably they got caught on the wrong foot. What do I mean by that? Oh, wait, let me just have a look here. So what's going on here? Okay. Getting caught on the wrong foot, it's also a very important question to ask yourself. So where is the overall market standing? What I prefer to do to get an additional information, especially in the current environment, is I check out the website, which is called barchart.com. It's also for free. You can check it out here, futures, and there we have the so-called commitment of traders report. And if I now take a look here, we have it here. We look at the E-mini S&P, and why does it matter now? Well, it matters because it shows how so-called non-commercial traders are positioned. So what or who are they? These non-commercials? Well, these are large speculators consisting of managed money and other reportables. So these are not small speculators like us, for example, who don't need to tell, like the in this case CFTC, how we are positioned, because we are just too small to report our positions. But the non-coms, these are the big guys, and the big guys, they have to report their positions once they hold a leverage position, for example, in the mini S&P, for example. And as you can see here, they are covered with this green line, and this is below zero, which means currently they are minus 150,000, which means they are 150,000 contracts short, net short. They already covered some of it but still they are short. And if they are not caught on the wrong foot and the market squeezes higher, because, for example, where if they are forced to liquidate their position because the Fed is now reversing course, they probably built this position, as you can see here, that was from June onwards. They started to build a short position here into the last sharp rally from June into mid-September, August. Around 2 months, they started to build a short position, which is now playing out nicely for them because they shorted into this retracement. And then they now see, well, probably the restrictive monetary policy path from the Fed, we peaked. Probably we won't see that many rate hikes anymore. We'll see even a looser monetary policy stance due to these recession fears, which is underlined by the comments from the United Nations, for example. I mean, the United Nations are talking about the markets and recession fears. That's something which is, I wouldn't say spectacular, but it's something which you usually don't hear that often. Probably like the IMF is talking about this, where like, yeah, some politicians were really talking about, but the United Nations, in my world, they are responsible for something else. Let's put it that way. So, and this development here now with some market participants being caught on the wrong foot, and as you can see already, we saw the push to new yearly lows last week on Friday into the quarterly close of the third quarter. And we already saw over the last weeks here, because this is weekly updated information, you can already see here there was kind of a push higher already, which is showing that the market participants who build a short position here into this leg, they are probably already covering it, which means they are probably reversing course. And if this accelerates now on the upside, due to a shift in the monetary policy expectation from these market participants, this could really push us significantly higher. Probably that was one of the drivers for the push we got to see here. And now the interesting thing is happening, because we are holding this level here on Wednesday, ADP data set. Let's have a look here what happened on Wednesday. So this was the release. Nothing big happened, in fact, here. Wall Street comes in, we flush lower, and then we were already below water for the day by -2%. And then the S&P bulls took over and pushed us to nearly break even into the daily close. So that was a sharp reversal. From there, we saw some choppiness, we saw some drift lower. But what I really look at here was the reaction on the ADP data. So ADP come in better than expected, rising speculations that the NFPs will also see a surprise on the upside. It's not a big surprise, but at least some which let some market participants probably say, well, probably we have a good reason to cover here after the sharp run into the first 2 days of the quarter. And then we reverse course and push higher. So that being said, now leaves us come to my overall idea when I'm saying, well, let's say we flush, in this case, we flush now below 3,720, but we can now make 3,720 back, similar to what the ADP data presented us. So this is definitely something we need to keep an eye on, and what will drive our decision now in the upcoming minutes. What we want to see now with markets coming in right now. So Wall Street opening. Okay, and now what we want to see here in this context is now the S&P pushing back and holding above 3,720. If this happens, I consider this initial flush to be done on the downside, and probably a little overdone, with already a first reaction showing that we are capable of making these losses back, and then really buyers stepping in, pushing us up to 3,700, 3,800. Probably even be above that level in the days to come. But right now, for formulating our thesis, we have everything together now. Now we need price action to confirm this thesis, which happens once we make it back above this. Let's probably make this a purple line. So that's what we want to see now. And if we get to see this, so now we have some, let's say, probably 30 minutes, 45 minutes. Let's see. If we make it back above this pink line, then I consider this to be a bullish sign. If we don't, It's also an option. Certainly it's an option. If we don't, well, then I could imagine that most of this run from Monday, Tuesday will be given back, not necessarily today, but probably in the upcoming week of trading, in fact. So probably this is then a very likely scenario, because this is a potential fake out, and we weren't capable of holding the breakout region here on the upside around 3,700, 3,720 in this case. Still, if we make it back above that level and we can hold it, so that's probably let's do it that way. 1 second. So if we now come back above that level and hold here, then I want to be long with a in fact tight stop. Let's probably see how things play out here, but I don't want to be long if we can hold a 3,720 then. But if we hold above, tight stop below that level, and I expect the market to push up to 3,800 and even a plus, and probably even a push above that, which could see an acceleration on the downside. I'm sorry, on the upside once next week's CPI numbers come in. So this is also something we could probably have a look at then next week, in fact. But first of all, let's focus on the non-farm payrolls and how things play out here, and if this plays out at all. So if we don't make it, if we retest that level, but we can't reclaim that, then I probably say, well, this is a region against which I could imagine also to find an interesting short entry. So if we stuff, let's say, into that level, and then we are topping out here, but we're not making it back above, well, then I'm willing to take the short side on the other hand and expect the market to close significantly below 3,700 with further potential on the downside, probably even new yearly lows then in the next week to come, and a push below 3,600, probably then with targets around 3,550, 3,500 on the downside. So we have a clear inflection right now. Bulls are in charge. So bears are in charge. Holding us below 3,720 is a bearish signal. If we can make it back above that level, that was a potential fake out. Some market participants are probably caught on the wrong foot here, then taking long positions or covering their shorts and piling into new shorts from here, and then we probably accelerate on the downside. But that's again something we now need to be patient about. We need to wait if we can recapture that level. So that's it on the S&P. That's it on the S&P 500 in this case. Now let's have a look at the second scenario, gold. If holds 1,700, see if breaks 730, then long target 760. Unfortunately, I have to say, oh no. Well, we traded below that level. Now I'm positively surprised. We broke, as you can see here. Why did we break? Well, there's usually a negative correlation, or not usually, but most of the time, negative correlation between the US dollar and gold. So gold is usually a hedge against a depreciating US dollar and vice versa. So currently you can see that gold has been under pressure for some time now with the US dollar appreciating as it did over the last months, while gold, for example, stayed quite stable. In euro terms, also saw new all-time highs, if I'm not mistaken, in pound sterling terms, also in JPY terms. And so main reason for that is there's a high yield sensitivity. And so with yields pushing higher right now, US dollar strengthening, as we've seen due to the non-farm payrolls, and rising expectations around the Fed probably going for the more hawkish stance, which market participants started to somehow price out on Monday and then following the RBA on Tuesday. So now, as you can see, we also saw a sharp rally starting already last week on Thursday, and then with an acceleration on Monday, topping around 1,730 on the upside. And also here, we had this flush now below a psychologically relevant level, 1,700 USD. And then I say, well, if we see the flush, something you expect if US dollar pushes higher and equities are sold in the current environment. But now the question is, can we make it back and hold this level? And as you can see, we saw an aggressive flush below, but we are bought back and right now trading around 1,700. This is strong. I'm not that optimistic in terms of gold when looking in US dollar terms when looking at this chart. So this is like it's a clear downtrend. It's obviously here that this is a retracement which we find ourselves in this current short acceleration and this further leg on the downside. So I don't want to be aggressively long here, but still I think it's worth to give it a try if we can break above the recent highs around 1,725, 730. So I rounded it up, so it's 727. If we break this level, this is an interesting long trigger because I first of all have a clear level to risk against, because these are the NFP lows. Probably I place my stop something around 1,698 or something. And I also have a vision for the overall picture, because then I zoom out and I see, well, if we break above 1,730 here, this area, which has been sort of a resistance already at the end of, or at the beginning, the first 2 weeks of September, after we then broke to new yearly lows and multi-year lows, in fact. But if we can make it above that level, if we can break that level, 1,730, I see some potential minimum up to 1,760, as you can see it here in my scenario. I wrote it down, but you can also see the plus here. I could imagine more bullishness to happen above that level, which leaves me to come to the following idea. One second. I will just use this one here. So, which leaves me come to the, let's work with an hourly chart. It's probably a little more detailed then, which leaves me come to the following idea. I say, well, I'm going long with a break above that level, 1,730 or 28, whatever, 128, risking against here, 1,698, slightly below the round number. And then I go for a trade, which I structure the way that I say the first position, half probably, is kind of a momentum lot. So strong move. I really expect the market to push into, and once it breaks above, really accelerate on the upside. So I don't want to see some like oh, we try somehow to break out and then some uncertainty coming in and buyers not really stepping in. I really want to see coming in, pushing away from price on the upside. So really taking on momentum on the upside. And then I target for 1,760, let's say for the first half of the trade. So this is where I would probably take out, if I'm trading this with one lot, I take out half of this lot here against 1,760, but keep the rest of the position for a swing due to my expectation that we are then probably breaking the downtrend here, and are probably headed for another test of 1,800 USD on the upside. So that's a way I'd like to play it in this context. And yeah, I really prefer to trade it that way. So going for breakout trades, 1,728, 1,730, momentum, targeting 1,760 for the first half, and keeping the rest of the position for a run up to 1,795, 1,800 probably. And even there, depending a little on where we come in, even there, I could imagine, in fact, to probably take out another quarter of the position and keep the rest, due to the fact that I haven't prepared this now, but you can look this up yourself. There's a bullish seasonality, especially in the month of December, taking over in precious metals and especially in gold. So somehow trying to profit from this bullish seasonality, if this trade starts to work for me, and keep the rest even for a longer time frame, for several months, probably into the beginning of the new year, 2023, probably end of January, probably, from a seasonal perspective. So structuring a trade in different, let's say, tranches, and then saying, okay, I have a momentum trade, I'm going with in this case, while we are looking at an hourly chart, probably for several days, probably something like that. And then a trade which tackles probably the next 2 weeks, 3 weeks, going up to 800, and then taking the rest probably for 1 to 3 months, probably from a seasonal perspective. So that's it on gold and how to trade this. And then this is probably the most tricky one, because it's not really NFP based. It's more kind of a, let's say, intervention trades. That's probably a good way to put it. Dollar JPY. So, and we can already see that here. So you can see a clear acceleration or depreciation, and probably that's probably a better way to put it, when looking at dollar JPY, or at the JPY, Japanese yen in this case, due to the fact that there's a big divergence of the monetary policy approach from the Fed compared to the Bank of Japan. So Bank of Japan says we are all in, we double down, and we won't hike rates. Instead, we increase our willingness to pack 10-year Japanese government bond yields here at a level, and target certain rates for the future, and intervening not just in the bond market but also in the equities market to some extent. Certainly there's now capital outflows from the JPY, which is certainly resulting in inflow, or buying especially commodities at much higher prices, which is importing inflation, which is now bringing us to expectations that rather sooner or later this depreciation, as we can see it here in JPY, will be countered. The only problem the BOJ, the Bank of Japan, is facing here is, well, they can't do anything in terms of hiking rates. But as you probably know, the biggest creditor of the US is not China, but it's Japan. A number which is fully transparent, available once you Google it. So creditor Japan, US, and you will find that Japan is holding a big part of US debt, more than 1 trillion USD, which means they can flood the market with the US dollar and trying to depreciate their currency. Why is this of importance right now? Because they did this here. That was at the end of September. You probably have read about it. That was the stealth intervention, which was then directly communicated from the BOJ that day. And then look where we traded. That was slightly above 145. So this is a level we should certainly have a closer look at. You can see here that we flushed on the or we saw very volatile reaction to the non-farm payrolls due to the yield sensitivity of the JPY. And the interesting thing now is that we are currently in an environment where we should expect, probably rather sooner than later, a next intervention from the Bank of Japan here. So which means that we should carefully watch this current price action. And especially if we drop now the post NFP lows, which we will find at around 144.50. If we sell off from here, failing to conquer 145, rolling over, I'd really like to short here dollar JPY, only with a small position, because things can turn very ugly in a currency which is that directly and aggressively intervened into, and then having a stop at the high of this news event, which brings us at the risk of something like 100 pips, and then betting for another sharper flush on the downside, probably driven by an intervention from the Bank of Japan, potentially pushing us again back to 140. On the other hand, we should be aware that if we take out the intervention high here of this candle and push above 146, we could see an acceleration on the upside. On the other hand, pushing us up to probably 150 even in the next days to come. So, and as you can see, a little more tricky. I think the situation is more clear here when we look at gold at 1,700 USD respectively. When we look at the S&P, let's see where we are. Oh, that's not good. This is not good. This is really ugly now. So things are turning really sour. Now we're 15 minutes into the trading day. There's no real sign of holding the 3,700. I mean, we were talking about 3,720, and this is ugly. So that makes it likely that most of the gains we saw here into the first 2 days of the trading week are probably given away again, if now bulls are not really stepping in quickly. So this is really ugly right now. Yeah, so again, let's see how things play out. Probably we see similar to the ADP data, as you've seen here. So that was we stepped in from when did we step in? Let me just see. Timestamp. Yeah, something like after 1 hour into the trading day. So 45 minutes to go. Probably a little more ugly because NFPs are more watched, let's say, around the globe. Let's see if buyers step in there, but if buyers don't step in aggressively and don't push us back significantly above the opening print, which we can right now find at around 3,700, this could turn out to be really ugly. And then God beware next week with the CPI data. If this comes on above expectation, I probably could even imagine the S&P see new yearly lows. That's that day then. Yeah, so I hope you take something away from the thoughts here around this webinar. Let's go back to the presentation and the last slide. If you have any questions and you haven't asked them right now, if you watch a recording now on YouTube, feel free to ask them below the video in the comment section. If you like the video, then please leave a thumb up here, subscribe to the YouTube channel, and if you have any questions around Admirals, feel free to reach out to their service and customer support. So here are the contact details, global@admiralmarkets.com, and so on and so forth. And yeah, I hope you enjoyed the webinar. So if you have any questions, again, shoot them over in the comment section below. And that's it from my end. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Talk to you again next week. I really look forward to it. All the best. See you. Bye-bye.